Good afternoon. This is Mike Bertelsen, the Bear Market Investor, the market update for the 14th of August, 2011. For those of you that had paid attention to my videos in the past, welcome back. I really appreciate the fact that you are back here viewing these videos. If you do like them, of course, please do give a thumbs up or post a comment on the YouTube channel or in the video comments section. I would appreciate that. It's just always nice to know that people appreciate what it is I'm doing here. And again, for those of you that have been with me for quite some time, I do apologize to you. I have not really had the opportunity quite a long time to be able to produce a video for you. When life gets really busy, sometimes you need to put your hobbies on hold, and that's what I had to do in this particular case. So nonetheless, let's go ahead and take a look at our charts. Now, we're looking at the monthly time frame here of the S&P 500 stock index. And what I've done is I've put the 200 period moving average, or 200-month moving average, and you can see right here where we are. We're resting right on that. And this has actually presented a really interesting opportunity for us as far as Elliott wave technical analysis is concerned. And we'll get into that a little bit more shortly. But what I want to do is show you the long-term picture of what the S&P 500 has been doing over quite a long time. It's really been in a long-term topping pattern here. And what we had here is we had a peak back in 2000, dramatic sell-off. We had a dramatic rally into the peak there in 2007. From there we had a very steep 5-wave sell-off. We had a 3-wave push to the upside here, and I'll explain a little bit more about why this was so tricky to determine the end point. There's a lot that goes into analyzing waves as far as Elliott wave theory is concerned. And what I was trying to do was understand exactly what the proper wave structure was, and until just recently that was not entirely clear. I had some high probabilities, and it turned out actually, ironically, that the first thing that I thought of originally, perhaps even in the last video, was actually what happened. It just wasn't quite as I expected it would turn out in terms of the way the waves looked, but it actually did occur. And so subsequently I had to second guess myself, or I was second guessing myself, and thought that we still had a little bit of additional upside, but I will show you that in the daily chart here in a moment. In any case, what we can see here is we have these two bluish purple trend lines right here. This that you can see right there, we have one that crosses right there, going all the way back to this peak back in 2000. We have this one which started back in the late 90s. We had a touch there, another touch here, and these are exactly parallel to each other. They're parallel from the standpoint that when you look at it in a certain type of scaling, they line up directly, as do these cyan trend lines right here up at the top, and this when you have it in the other type of scaling. So regardless of which scaling you look at, this bottom lines up perfectly here all the way back from the late 90s in through the bottom here in 2002 and again in 2009. So we did actually go and push up into the upper boundary here, as I had been suspecting we would. And if you were to turn this slightly counterclockwise, it would look like essentially a large head and shoulders topping pattern. Of course, that's not what we have here really in the S&P 500. We have more of a double top pattern here, but I wanted to show you exactly where I thought we would get that resistance. And if you look at the videos that I made in the past, I've pointed this out time and time again, that I believe that we were going to head up right into this area of resistance, and that's exactly what we did. Now we're going to go ahead and jump into the weekly and then the daily time frame, and I want to go ahead and show you some thoughts and opinions on that. But first of all, let's go ahead and take a look at this monthly time frame here. What we have here, a monthly time frame, it's very clear. Like I said, 5 waves down. We have a 3-wave up, and so we're expecting that what we're likely going to see is at least another 5 waves down. Now that depends on whether the top of the market, as far as an Elliott wave count as far as an Elliott wave count is concerned, was actually back here in 2000, or whether it was right here in 2007. Both are legitimate, but there are slight differences in how this could work out for us because of that. And I'll get into the specifics on that later, because it means the type of correction we're likely going to see. But from what I can see right here, we are definitely going to take out this March 2009 low, or I should say there's extreme probability of that. Nothing is definite in technical analysis, but based on Elliott wave count, that is by and large the highest probability event. Any other possibility is almost minute in comparison to the count that would have us breaking this low right here in March 2009. Now that said, let's go ahead and have a look at our technical indicators. What we're seeing here is we have a divergence here in the monthly time frame. We have a divergence in the MACD histogram, and we're rolling over here in the MACD itself in the monthly time frame, about to go negative here on that histogram, and that should bring us in to a new bear phase here in the monthly time frame. We're also seeing that stochastic rollout of overbought territory, breaking a trend line here that we could have connecting this low and this low right here. And I expect that that's going to continue. We're also seeing a divergence right here. As you can see, this particular top registered pretty high here in the monthly time frame on the RSI, but it did not register high right here. That is also a strong indicator that this is a counter trend rally. So without further ado, let's go ahead and jump into some of the other time frames. Now we're looking at the weekly time frame of the S&P 500 stock index, and what I want to do here is show you what the technicals look like here in the weekly time frame. And I also want to talk a little bit about the Elliott wave analysis and why I believe that we have already seen the peak in the market. Now, not only does the monthly chart look bearish, as I was showing you here, we also have a fairly bearish looking weekly chart as well. We're showing a lot of weakness here. Now, we do have a little bit of a hammer candlestick, but don't let that worry you right now. What I'm seeing here is that we had a pretty clear 5-wave push to the upside here to complete an 8-wave. We had a 3-wave pullback, which was a little bit confusing there until, of course, we concluded that we did not, in fact, have a top, because originally this looked like a little bit like a triple zigzag, which, of course, can look like a 5-wave push. But in fact, this turned out to be a 3-wave decline here. It just had some really sharp edges there, and that was getting a little bit difficult to actually determine the proper count at that point in time in the market. From there, we had another 5-wave push. Now, this push actually, and I'll show you why, ended up here. It didn't actually end at the top level as far as point value in the S&P 500. It ended after that. I'll show you why that is in the daily time frame, and a lot of wave analysts have gotten this part wrong. Now, the bullish Elliott wave count, this is what they would be telling you if they're a bullish Elliottian. They'd be telling you, well, okay, yeah, we have something called wave overlap, which of course is a rules violation as far as Elliott wave is concerned, meaning if this was really a 4th wave, we can't have the 1st wave and the 4th wave coming in to the territory of the 1st wave, which it does. So what they would tell you, as long as we don't break this low right here, what we're going to see is we're going to see a probably, at least even from this particular point, or perhaps another sell-off, they're going to say, well, we're going to rocket ahead, because that would make this top right here wave 1 of 3. And then we're going wave 2 of 3, and that we would rocket up in wave 3 of 3. Now, if you pay attention to the news, and I'm sure you do, it's hard to miss just all the bad news coming out of the world, and with regard to the economy, with regard to just general social psychology. And I don't believe that news moves the markets. Okay, you actually saw here a peak in the stock market as far as points are concerned back here, but everybody was blaming all sorts of different stuff for the decline. I mean, it was the European debt crisis, it was the London riots, it was this, that, the other thing. It was not raising the debt ceiling. Come on, or threatening to not raise the debt ceiling. Give me a break. I personally believe we should not have raised the debt ceiling, but not going to really get into that argument right now. Let's focus in on the markets now. So the bullish Elliottians would be telling you that this would be a pullback in wave 2 of 3, and that we'd rocket higher. Now, like I said, if you pay attention to the news, it's hard to miss the negativity out there. The negativity when it comes towards a market top is not a signal of further bullish potential. You should not be seeing that in a third wave. Okay, if we're indeed in a third wave here and that this market is going to go up higher, we should not be seeing the type of negativity right here. We should be maybe seeing a little bit with this sell-off, but not to the degree that we're seeing it out there in both fundamental analysis of the economy and the stock market, but also with regard to general social psychology. Right now, it is just, the world is a mess, let's face it. So the bullish folks would be telling you, oh, don't worry about all that. We're going to rocket ahead. We're going to move past that 2007 peak in the S&P 500, and it's going to be the most powerful wave that you'll ever see in your life. Now, I just don't happen to buy that, and I hope that you can probably tell where the truth likely is in that, although, of course, we have yet to see. But when you see the monthly chart, as I was showing you before, we had a clear divergence between this wave and this wave in, the RSI and in the MACD and MACD, or I should say in the MACD histogram. And it's pretty clear to me that this is a counter trend rally. Okay, now there's different types of corrective waves that you can have. You can have triangles, you can have flats, you can have all sorts of other things. Now, the simplest corrective form is a zigzag. Now, it's hard to tell whether that's what we're having right now off the March 2007 March 2007, the 2007 high, or that we're going in an expanded flat correction from the 2000 high, and that we obviously penetrated that high slightly in 2007, making a setup for an expanded flat correction. Now, I believe that the broader stock market in the United States is in Grand Supercycle Wave 4. Proctor has put out some really good charts on this thing, and I dispute him a little bit on some minor things, but overall his charts are extremely solid. This guy is a literal genius. I don't think people really give him the credit that he deserves, because, I mean, this is the guy that was also the president of the MTA, or the Market Technicians Association. He's very, very bright. I just can't even hold a shadow to the guy's intelligence, with my own. So, in any case, I'm going off of his long-term chart. I take a few differences in opinion with him on what the top might be, but let's go ahead and say that it's that 2007 peak. Okay, 2007 peak. We had a 5-wave decline into here. We had a 3-wave rally. That would suggest that we would likely see a 5-wave decline from here in the completion of an ABC correction from that 2007 peak. Now, when you look at Elliott wave technical analysis, like I said, we're coming off of a Grand Supercycle Wave 3 going into a Grand Supercycle Wave 4. That is a massive wave structure. Okay, we're talking many, 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 many decades. The super cycle that we're coming out of completed, of course, and we have to come back down to the fourth wave of lesser degree. That means coming back down to the super cycle wave 4. Believe it or not, that has the S&P coming back down below 250. And if we look at larger cycles in the stock market, what we see is that the larger cycles are all pointing down, and they're pointing down, they're peaking in and around the time frames that, of course, we are. That technically maybe a little bit later, if you want to consider it a little bit of a late sell-off. If we had lasted until 2012, the cycle suggests that we could do that. It just wasn't the highest probability type thing. Now, the cycles all point down until 2014 to 2016. You could see some markets start to bottom in that 2014, maybe even mid-late 2014 area. But I think you're going to see the broader markets begin to bottom in that 2015 to 2016 time frame when we move back into the range of that super cycle wave 4. Okay, so that's what Elliott wave technical analysis tells us. When we are coming off of a peak, off of a 5-wave push that we were into the end of Grand Super Cycle Wave 3, what that tells us is we have to have a correction, and that correction will likely end in the range of the fourth wave of lesser degree, which happens to be Super Cycle Wave 4. Okay, so that will bring us back into something potentially that we would have seen in the stock market back in the 70s. And again, that's really difficult for people to envision, but I'm just telling you what Elliott wave analysis tells us. And that's the type of deflation that I believe is in store for us. Now let's go ahead and jump into the daily charts after I have a chance to show you what the technicals are doing here. Momentum continues to strengthen to the downside, and we're seeing that here in the MACD histogram with this last week here registering a new low beyond this right here. We're seeing the MACD continue its downward slope, and in fact we have a negative reading right there on the MACD. That tells us here in the weekly time frame that the momentum is favoring the bearish outcome. We have a very negative reading down here at 1750 on the MACD histogram. Likewise, the stochastic is also showing a lot of weakness there in at 2527, and the RSI is continuing lower as well with a reading in at 2824. Now there is more downside to come here in the near future, but I do suspect that just based on how oversold the market is, after one more push potentially to take out this low right here, we will find a temporary bottom or some temporary relief for the bulls there that will allow us to rally up, and probably a fairly sharp rally. So if you are short the market, do note that I am suspecting that we are going to see further downside that may come in and find some support in this area, or perhaps this area right here. But regardless, we are going to see a snapback rally, and I think that rally is going to be pretty big, and it's going to be reflected in the news as some very positive news of some sort, or some positive relief that the worst is over. I would suspect that if you can reflect back on this video and reflect back on the news, that you'll see right through it and know that the relief is probably fairly short term. Now let's go ahead and have a look at our daily charts. Okay, we're looking at the daily chart of the S&P 500 stock index, and I want to first apologize for the Fibonacci overlap that I have here. I have the Fibonacci still up from the 2007 to March 2009 low, as well as this right here, and so you're seeing this chart look a little busier than it should. I'll try to clean that up next time. In any case, what I want to do is discuss exactly what the wave structure is. And I can say this with a great deal of certainty now, especially with this sell-off that we had and that wave overlap that I was talking about in the longer term. And why, unless you want to accept the bullish Elliott wave count, that we did in fact top already, and that we will be moving down for quite some time. Now, the wave structure was a little bit curious here to me, because we actually had a three-wave decline and then we had a three-wave push up. Now, I cannot for the life of me understand why some Elliotticians believe that in fact we did top the Elliott wave count with a wave 5 of C at this particular point in an ABC correction from the March 2009 lows, because clearly the wave structure does not agree with that. This is about as plain as daylight. We had an A, B, C. Now, why did we have that when we went beyond this peak right here after a three-wave decline? Now, that sets up three different possibilities. That sets up either a running flat, an expanded flat, or a running triangle, meaning this was part of a wave 4 of C. Now, the confusing part to me was that when we found support here and we rallied, and the way this really is best broken down as 5 waves, but it looked like it could have been a 3-wave rally right here, still not very clear. We had a decline there, we had another decline here. Oops, we broke the boundary of this triangle right here, but we had a nice setup for a running triangle. And with that steep sell-off and that wave overlap, we can officially say that that was a bogus count. Now, my original thought was, and this is the one that I think I mentioned in the last video, but I certainly mentioned in the YouTube comments section early on before I started second guessing myself. I shouldn't have done that, but I did. It's human nature to second guess yourself sometimes. In any case, we did actually have a 3-wave rise there. We had a 5-wave decline. Now, the Elliotticians that are saying that this marks the top is curious to me, because we had a 5-wave decline after that. That exactly fits a flat style correction. So why they are saying that is beyond me. But in any case, after that, we did have a 5-wave push to the upside. Now, this is where it gets interesting. The rules of Elliott wave technical analysis tell us that we have to move beyond the termination point of wave 3. We did that. I was just expecting us to move beyond this point, okay, to actually touch this up here. But keep in mind, this is an extremely long-term trend line, as is the one below it here. It would just depend on whether you considered the top of the candlestick, and whether or not you included the shadows or not on the candlesticks in the long-term charts. In any case, we did get pretty darn close to that. We also got pretty darn close to that 78.6% retracement from the 2007 peak, March 2009 low. And so we pretty much met all the criteria that I was expecting. I just thought we were going to have a new peak in the market. And so I started second guessing myself, but we actually did have something that met the rules for a running flat correction and then a 5-wave finish in a 5th wave of C, which ended at this point. Therefore, we have wave, a first small wave down here, second wave up, a third wave down. I believe that third wave ended here, and that the 5th wave did not in fact end. Now I think we're just about to wrap up, if not already, a 4th wave up. We should see a 5th wave down, which will take out this prior low, and then that's when it gets fun, because what we're going to see is we'll be able to move this Fibonacci point back over here. We're going to be able to move this down to the new low. And then I think what we're going to see is a really strong snapback rally, which is going to bring us up to a 61.8 Fibonacci. And that's going to be that little, snapback rally that I was talking about. Certainly, we've had some pretty wide range bars here just overlapping one another, and we're starting to see some signs that maybe the market isn't going to move too much higher, and I think it probably will move slightly higher here, but not by much, and I'll show you that here in the intraday chart in just a moment. But certainly the technicals on the daily chart are just looking extremely bearish. We have a very deep histogram here in the daily time frame. We have very deep MACD rating. We were in oversold territory right there, and we're seeing very, very weak readings here again on the RSI. So again, a very bearish looking daily chart, and certainly we moved well beyond that 200 period moving average here in the daily time frame. We found a little bit of support there to just conclude the fifth wave of C at this point, not this point. The Elliotticians that are telling you this are not following their own rules and guidelines, and that's why I don't understand why, if they consider this a 5-wave decline as part of a wave 1 down, and that we have wave 2 up, that they can't possibly contemplate this as a running flat correction, because certainly we did have something very similar to that in other markets where we actually had an expanded flat correction. It just turned out to be a running flat correction in this particular case with a very short fifth wave. In any case, that is the wave structure. Wave 1 down, wave 2 up, wave 3 down, wave 4 up, and then we're going on to a wave 5 down, followed by a second wave rally in the next degree higher anyways, which again should bring us up to a 61.8 on the Fibonacci from the entire decline from this point down to the fifth wave low that we have. So that is where I expect that we're going to see, after that larger rally takes place, some serious selling enter into the market, because that's going to be a third of a third wave as well, and a much higher degree third of third wave, and so that's when the bottom falls out on the market. Now we'll look at that as it happens, but do note, again, nothing is for sure in technical analysis, but I'm telling you my reading, and based on the rules of Elliott wave technical analysis, which are quite solid. It's just the analysis part of it up until the point where you get confirmation, leaves you probabilities and things of that nature, and you just have to take at that point what the probability is. But once you get confirmations, it's pretty solid. But again, anything is possible. I mean, we could have to throw this count out the window for something else, but I just don't see that at this point, because we have a very, very solid reading here from an Elliott wave count perspective. I've shown you what the wave structure breaks down as, that we did not violate any rules there, and that we probably should see a little bit more selling here, assuming that we did not have a fifth wave down, but I don't think we have based on this correction here. I think this being about an equal amount of time frame, we might see a little bit of upside on Monday, followed by some selling into Tuesday, perhaps Wednesday, Thursday, Friday, as far as the sell-off is concerned, may conclude next week, followed by a pretty sharp rally. But we'll have to see. I mean, we can have very extended waves, we can have all sorts of different stuff occur, so I don't want to put the cart before the horse here. I just want to tell you that as far as my count is concerned, I'm considering us to be in a small fourth wave here, and that of course we're going to see further downside, followed by a very sharp rally and a wave 2 up. So that said, leave comments on the channel if you would. I would appreciate it. Thank you for sticking with me on this very long presentation, but I hadn't been with you for a while, and I really want to teach you something as well as show you what my opinion on the market is, and I think that's an important thing. Some people just want to get down to the nitty-gritty. Tell me what you think the market's going to do. I really hope that you come out of this experience watching these videos learning something as well. So in any case, have a great night, and hopefully I'll see you next week. Thanks.